everyone, welcome Andrew Freed to the podcast. Andrew, I'm super excited to have you on and talk a lot about, where you are today. Obviously, scaling really quickly, building a team, and what looks like, buying properties every week. Is certainly excited to talk more with you. So thanks for coming on. So Andrew, for those who out there who don't know who you are and what you do, give people, the 30 to 60 second recap of what you have going on now and what types of deals, projects you've done over the past year.
So what I have going on right now at this very moment is I have a 21-unit acquisition in Lowell, Massachusetts. And for that particular deal, we are actually taking that down with one equity partner. So Zach and I are bringing about a sixth of the money, and the equity partner is bringing around 2/6 of the money. He's going to give the LLC a loan for half of the balance, and we're going to pay that out at the refi and keep the asset 33% each. So that's a really good deal. Excited for it. Excited for the equity play for that one. We also have a 3-unit acquisition in Dorchester, Massachusetts. We're buying that for about $1 million. It needs about $150,000, $200,000 worth of work. And we're going to sell off each condo for around $600,000. So that should be a really fun project, very profitable. We also have a 35-plus unit building in Worcester, Massachusetts that we're currently doing the due diligence on, and potentially raising around $1.6 million for that deal. Additionally, we have a 5-unit in Worcester. We're getting it for about $730,000, needs about $50,000 worth of work. We'll be worth about $1.1 million once we're done, and we're planning on putting our property management company in the commercial spaces on the bottom. I have a 4-unit wholesale deal in Connecticut, and I definitely have some more deals in the pipeline that I am forgetting about.
That covers quite a bit. And over the past year, you've bought how many units?
Over the past year, me and my partner have purchased approximately 175 doors. Our goal is to get to 300 doors by the end of the year.
That's awesome. And for those listening who might not know all of the lingo that Andrew's talking about, basically, Andrew Freed buys multifamily properties. He partners with people, and he does what's called syndication, which we will dive into in a few minutes, raising money from outside investors. And now they're getting into more of the redevelopment, flip space, which is this exciting turn for the business, and definitely curious to hear more about what that looks like. And to start things, if you could give the people listening a recap of how you kind of got started in real estate and where, you've come to today. Obviously, to be able to do those types of deals, if you could give that, a quick background story on yourself so we know more about you.
Totally. So like many people who are listening, I was, I don't know if deceived is the right word, but I followed the American dream. I thought that was the path towards financial freedom. So, I got a good education, went to a good school, got my master's, got a 6-figure job at a prestigious organization, and come around 30, I essentially made it, right? But after reading Rich Dad, Poor Dad, I came to the realization that it literally took me 10 years to save up $250,000. And in Rich Dad, they give little hints of the power of real estate. And I really looked at my net worth, and I came to the realization that 80% of my net worth was in this 1-bedroom condo I bought 5 years ago. It literally took me 10 years to save up $50,000. And at that point, I knew my journey to financial freedom would be unsustainable with a typical W-2 job. And I really had to make a change, right? So at that point, I really decided to go all in. I took a HELOC, a home line of credit, on my 1-bedroom condo in Boston for around $200,000. And I utilized that to start buying multifamily in Worcester. So in Worcester, I literally knew nobody. But what I did know is I wanted to buy multifamily, and that was my market. So I literally moved out to a city I knew nobody and started expanding my multifamily portfolio. So I think in year 1, I got up to around 10 units. Year 2, I think I got to around 24 units. Year 3, I got to around 125 doors. And then I'm in my 4th year, I'm going on 300.
Wow, that's awesome. That's quite the acceleration too.
Yeah.
And I know, for you, part of it was largely with strategic partnerships, deciding when you needed to raise capital. So what was one of those acceleration points for you going from 10 units in year 1 to 100 units in year 2? What was that stepping stone for you, and what did that look like?
The real stepping stone was realizing the power of branding and social media. So come around, my year 1, going on year 2, I was leading the largest real estate meetup in Worcester, Massachusetts. And at that point, I had somebody as a guest speaker who was a guest on the Bigger Pockets podcast. So afterwards, I explained to them, this has always been my dream to be in the Bigger Pockets podcast. So she literally took to do a warm introduction to a producer, and I got on the Bigger Pockets podcast, and that really accelerated my ability to raise capital. Not only like showing myself as having credibility and likability to the masses, but it also provided me internal self-confidence that I had the ability to raise capital. So at that point, right when I got off the Bigger Pockets podcast, somebody in my network presented me with a fantastic syndication opportunity, about 69 units in New Bedford, Massachusetts, which is about an hour south of Boston. And for that syndication, we were getting the units for approximately $80,000 a door, when doors in New Bedford trade for between $100,000 to $120,000. Made sense all day. We were getting a really good deal, but the deal finder didn't have the capital, and he needed somebody to raise it. So he thought of me with the fact that I was just on the Bigger Pockets podcast, kind of building a brand. And at that point, me and Zach took on the initiative to start raising capital for that deal.
When you say syndication, obviously you're talking about raising private funds from other investors.
Yes.
And allowing yourself to be, the managing or the general partner in that sense where you're actually heading the project.
Totally.
So at the point that you realized you needed to raise capital, you had the social media presence to support. Mm-hmm. But why did you feel like a syndication model was the model for you? And what is a syndication? And for those listening, we're going to get really tactical on this episode. So if you want to learn more about Andrew's detailed backstory, you can find Andrew all over the internet. But today I want to get really tactical, dive into raising money at a high level.
Totally.
So if you could, syndications, obviously investors pooling money together.
Yep.
What made you decide that was the model, and what is it?
So you bring up a good point, and this comes all down to deal structure, right? So there are multiple ways to structure deals according to the size of the deal and according to your goals, right? So the syndication model is more for passive investors, meaning that, more or less as the general operator, I'm compiling money from these investors, and they are essentially collecting mailbox money, and they're giving me control to manage the deal. And as a result, they're giving me a cut of the pie. Right? So syndication models sometimes are split 50-50 of the upside, 60-40, 70-30 with some sort of preferred guaranteed return. You can't say guaranteed, some sort of offered return annualized. And that's a syndication. So they're set up in a couple different ways. 5 or 6B, like boy, that's when you can only raise money from friends and family. And that's when you can't openly market it. And then there's a 5 or 6C that allows you to only raise money from accredited investors. You have to have a certain net worth, and you can openly market an opportunity like that. And think like Brandon Turner. Brandon Turner does 5 or 6 Cs, 5 or 6 Bs. You don't really see because it's all like under the rug, right? It's all between friends and family. It's not open and out there.
These are SEC regulations.
These are SEC regulations. And when it comes to syndications, they are actually not a security. You actually go to the SEC and request an exclusion from it being a security. But nonetheless, if you don't do that, you bring on a lot of compliance issues and legal troubles, right? So syndicating deals is incredibly important, because it more or less, when you take money from a passive investor, it more or less is a security or has to get an exclusion from being considered a security, as opposed to joint ventures, which everybody in the group is an active investor, meaning they have some sort of role in the deal, right? So when it comes to joint ventures, those are very straightforward to put together. You just create an LLC and put members on there, right? So a lot of times, these joint ventures, in my opinion, are better structured towards smaller deals that you don't have many, equity partners or partners in the deal. And some of these large syndications, they have immense overhead costs. You have to pay a ton of attorneys, a ton of legal fees. They're very expensive to create, roughly around $20,000 to $50,000. So it truly only makes sense when the purchase price of the property is over a certain threshold, right? And when it's under a certain threshold, joint ventures may make sense as long as you're giving everybody an active role and they're not considered a passive investor. And then there's another structure that we like to utilize with flips, right? So with flips, we can go to hard money. We can go to these hard money lenders and get loans at 90% of the purchase price, 100% of the construction. So essentially, we're only bringing 10% down for these deals, right? So with deals like that, we like to offer promissory notes to investors. So to borrow that 10% plus operating costs, we may offer a 10, 15, 20% return on their money, combine that with hard money, do the business plan, dispose of the assets, pay back the investors, keep the difference, right? So there's different structures on what sort of opportunities you're seeking. We utilize all three depending on the goals of our investors and the goals of the investment.
So as someone who's looking at those three, different strategies, obviously, the joint venture in simple terms is if you and I wanted to buy a deal together, we're both going to do the work. We're maybe both putting in money.
Correct.
And we're actively managing it.
Exactly.
Versus a syndication is me and maybe 5 of my friends saying, Andrew, we're going to give you, $50,000 each, but you're going to manage the project and you're going to deal with,
Correct.
handling everything.
Exactly.
And then we get a percentage back on our money for helping, investing in your asset.
Exactly.
And the hard money piece, that's a way for you to minimize how much capital you need to put into the deal, because you can leverage to say 90% of the total value or total cost of the property. In that sense, you would still use you're saying under your example, you would still have an investor come in to cover the initial 10% down payment, and then go to a hard money lender to get the difference.
That's exactly correct, yes. And I think the key word in there was leverage, right? Because when you really understand leverage, you can amplify your returns exponentially, right? So say, for example, there's this flip, this Dorchester flip. I'm set to make $100,000 profit on it, right? I could take 10% down, borrow $50,000 from an investor, pay them off, and collect the difference. Let's say $60,000 to $70,000, and my return on investment is going to be really good. Versus if the property costs $500,000 and I'm bringing all cash to that deal, right? And then I profit $100,000 off bringing $500,000 to that opportunity. That's only a 20% return, right? So if you really understand leverage and how to borrow money in the concept of arbitrage, you can really exponentially grow your returns.
Right. And you could take that same $500,000, instead of putting it all in one property, you could instead put that initial 10% down across 5 or 6 deals.
Correct.
So now you're able to, leverage from the point of just velocity. You're doing more deals, doing more transactions. But when you say hard money lender, what does that mean to you or to someone who might not know what a hard money lender is?
A hard money lender is essentially a private lender. Sometimes they're funds, sometimes they're an actual individual, right? But they're loaning you based on this property, right? And a lot of times they're loaning you based on the fact that there's built-in equity. So if you default on the loan, they have the ability to foreclose, take ownership of the property, sell it, and collect that equity that you bought at, on the sales price and get their money back. And a lot of times hard money lenders are easier to work with, quicker close times, and less requirements, right? But with that comes more expensive money. So from my experience in today's times, normally you're looking at between a 10 to 13% interest rate, interest only a lot of times, and with a couple points, maybe 2 or 3 points. That's kind of where you see hard money landing today. But when you're transitioning that hard money into returns that can offer you 30, 40, 50%, it makes sense all day to borrow it at a 13, right?
Yeah, and I feel like that's where a lot of people get stuck. It's same with buying, even your regular house, right? People think, they look at the interest rate and they shy away because of the number.
Yeah.
But you have to see the whole perspective of the deal.
Correct.
If you told me, look, I'll give you a loan at $100,000 at 70% interest, well, that's a crazy number. But if I can make 50% of my money, even with that interest cost, I might not care. Granted, I'll find cheaper money. Totally. So don't get any ideas.
I was literally pulling out my checkbook right now.
I saw your eyes light up. But the number itself is just another factor of underwriting a deal. How much interest cost you're paying. And it's just analyzing the numbers. So when you're looking at hard money, what types of opportunities do people typically use hard money for? Because it's not a long-term debt vehicle. It's typically shorter term. So
correct.
What types of ways do you use it, and how could other people think about it?
So the key way to use hard money is there has to be, at your exit of the business plan, there has to be some way for you to suck out the money to pay back the hard money lender and to make profit, right? So it could be a flip opportunity where at the end you make a profit from selling it, right? It could be you're using hard money on a value add multifamily. Maybe you're buying it at a 30, 40, 50% discount on the price per unit, and you can stabilize it in a year period, refinance your money out and pay the hard money lender back and keep a majority of the asset with little or no money down, right? So there has to be some point in the transaction that allows you to exit to suck out capital to pay back that hard money lender. To your point, usually these hard money lenders, the term is typically 1, maybe 2 years, right? So you really have to execute your plan quickly. Otherwise, that note's due and, you got to pay it, right?
Right. And so to someone listening, why can't my bank do that? Why wouldn't I just go to my bank and say, hey, I want to flip this house? Why does hard money make more sense than bank financing sometimes?
So you can get construction money from small local credit unions or banks, but I think the key here is the money down, right? I think it all comes down to the money down. A lot of these banks, especially construction loans, they require 25, 30% down of the purchase price and renovation versus hard money where you only require 10% of the purchase price, right? So you really can bring less money to the table and amplify your returns that way.
And so there's obviously less cash in the deal, and there's less stress, or I should say focus on you as an individual in that case. Granted, they want to, of course, have an understanding of your trust, your track record, but they're less concerned about like, what's your credit score, which is always a thing in lending. So
it's to your point, it's more about the deal, right? You got to bring them a deal where there's a big threshold between the purchase price you're getting and the built-in equity, right? It's very much dependent on the deal.
And if I was listening, I'm like, all right, well, that sounds great. I'll go get some money. My credit score is maybe not the best, or I'll find a deal, get some hard money. Totally. How do you find a hard money lender? And what types of questions should you ask them to vet them?
So you find the best hard money lenders at real estate meetups. Like those are where they get most of their clients, right? And how do you vet a hard money lender? Is you talk with prior clients, right? You talk with other large investors in the area and see who they use and see what their experience has been like with these lenders, right? So, referrals are definitely the best. And I've gotten my best hard money lenders through referrals. So those are kind of the strategies I would utilize when it comes to hard money. But, I do want to be pretty clear. Hard money is really meant for intermediate, expert level investors because, if you don't know how to operate the deal, if you don't know how to, budget correctly, like you could dig yourself into a hole and bankrupt yourself, right? So, you can make a lot of money, but you're also playing with fire, right? So you got to be careful with how you use hard money. The deal really has to make sense in multiple exit strategies, right? So maybe at the end of the year, you have the ability to refinance, right? If you're not going to get all your money back, maybe you have the ability to sell, right? But you have to have multiple exit strategies, at least for me, to feel comfortable using hard money.
That's really, really important to understand because it is fire. It's great because you can get cash quick, high leverage, but it's short term and it's high interest. So when you talk about exits, you talk about refinance. What do you mean by that? So if I take out a hard money loan, I just go to my bank and say, hey, bank, can I get this money back on a better interest rate? Like how would you advise someone think about an exit strategy on potentially their first deal with hard money?
So when it comes to a refinance, more or less, you go to the bank, right? And you get a new loan for the new valuation, right? So when it comes to refinancing, the key there is understanding your exit value, right? So you have to understand that once you do the business plan on this project, is my value going to be where it needs to be, where I can refinance all my money out and or sell it and collect the difference, right? So I think you bring up a really good point. When it comes to utilizing hard money, you really have to understand what we refer to in real estate as the ARV or after repair value, because that's going to signify that's going to signify your value for your refinance, and that's going to feed into your business plan on whether you can pay back the hard money or not.
Yeah, that's really important for people to think about too, especially from the structure up front. If you're getting hard money debt, you need to know what your terms will look like on your refi. Because if you're planning to refinance and keep the property, you need to underwrite based on your end financing.
Correct.
So rather than going out and getting hard money, starting this project, thinking you'll figure it out later, if you're not an experienced investor and don't have relationships with banks, lenders, that can be a really tricky point to get out of, especially when it comes to calculating your return, because you might not fully understand the end financing process. I have a lot of conversations with people sometimes proactively before they're doing their first flip. What does that look like? What types of options will I have? So we almost approve them on the end financing before they even get the first financing, because we want to know. Approve is obviously a vague word. I can't say approve, but we give them a good understanding of what they can expect on a refi based on an expected value and the type of underwriting approach we're using. So I think it's really important for people to know. But with hard money, how important is your operations team in terms of executing the deal? If you're going to take down a flip, is this something, use hard money, you're going to buy a single family, you're going to renovate it. How important is it to have experience in the project management component, construction piece to execute that?
So I think like we alluded to, when you're taking hard money, you're playing with fire, right? So just like hot potato, you want to get rid of that as quickly as possible, right? So having good operations and having solid project management skills will allow you to expedite your business plan in a quick fashion, getting you out of that hard money as quickly as possible, right? So, that's imperative, right? And when it comes to, effective project management, it all comes down to Gantt charts, right? And a Gantt chart is simply, if you have one item and it's dependent on another item, like what's the timeline that needs to be completed so everything gets completed in the quickest way possible, right? So understanding all the timelines, like the fact that the electrical and the plumbing has to be completed first before you put up drywall, before you do finishes, right? Like understanding all those timelines and getting your contractors aligned, as in alignment with that Gantt chart is incredibly important for staying on your timeline. And just going back to that point, you're talking about like wanting tactical advice to investors. One of the biggest mistakes I see from newer investors is not understanding the sales comp approach versus the income approach, right? So 1 through 4 unit residential properties are valued based off what everything else is selling for in the area.
Should be the sales comp approach.
The sales comp approach, and that determines your refi value, right? Versus 5+ unit properties, that's valued based on how much income it produces, or the NRI, referred to as the income approach, right? So a really big mistake I see from new investors is they buy a 4 unit thinking they're gonna plow a bunch of money into there, get the income up, and they're gonna refi based on the income approach. That's completely wrong. And you have the risk of over improving that property and not getting your money out, because when you go to the refi, they're not gonna be like, oh, this produces this much revenue. They're gonna be like, what is every other 4 unit in that area selling for? So just be careful, when you're determining your ARV and your refinance amount, that you're utilizing the correct approach on how people value property in real estate.
That's really important. Very much in line with that end game. Knowing how you're going to exit before you start, or at least have a couple options, is super important. And then on that note, something I know you take advantage of often is partnerships.
Yep.
That would be a great opportunity to partner with a more experienced investor. If you have a deal in front of you,
correct,
you don't know how to execute it, you can partner with someone who's in the business and has been doing it for longer, has the experience to, one, make money, right? That's the whole goal. Both of you make money, but then show you the ropes, show you how to execute hard money. Is that something you are doing in your business now, working with partnerships with some people who might have deal opportunities that they can't take down?
So you bring up a really good point, and this goes back to the whole syndication model or the joint venture model. When it comes to real estate, different jobs are valued differently, right? So if you find the deal, that's valued in some capacity. If you're operating the deal, that's valued in some capacity. If you're dealing with investors, that's valued in some capacity. So when you do these syndication deals, a lot of times you're providing equity based off what people are bringing to the table. They could find the deal, they could operate the deal, they could bring the money, right? What are they doing to deserve that equity? So we utilize this model very much in our business. Like when people bring us deals, we will gladly offer them equity. If people want to be boots on the ground and operate the deal on our behalf, that will get them a little more money. If they want to raise capital for the deal, that will get them even more money. What are you bringing to the table, and how is that valued in conjunction with the deal? We utilize this strategy a lot, and it has been very effective for taking down some of these larger properties.
No, that's I think for me and someone who certain projects that I might come across would want to partner with someone else. One, maybe they have more experience in that specific asset class, or maybe things just go better and farther together. It's easier to have 2 people working a deal than just yourself, especially when you're learning some of the nuances. So for newer investors, I feel like there's always that fear of like giving up money. I don't want to bring someone else in because I'm losing money, but you can't lose a percentage of nothing, which you have nothing until the deal's done. So there's a value in getting experience, out of that transaction.
So I think too many people think in the terms of, how much, like the capital perspective, how much money am I going to make on this certain deal, right? I don't think like that. I think in different formats, different dynamics. And one of the dynamics I do think of is network capital, right? So I could take down one of these larger deals, right? Maybe I couldn't raise all the money. Maybe I have to bring in more partners, dilute my percentage, and maybe I'm not making that much money on the deal. But I'm actually building a ton of network capital, right? So if I take down a 70-unit deal and, potentially I'm not making a lot of money on it because it's split between so many partners, that's going to allow me to scale my other projects that much quicker, right? Because I'm building credibility, I'm building likability, I'm building trust that people believe I can take down larger deals. So when larger deals come in my path in the future, who do they want to partner with? With me, right? So we should really think of, not all deals are meant to make money. Some deals are strictly meant to build credentials and build up your credibility to be able to take down larger stuff.
Yeah, that's super important. That was for you. was that New Bedford deal was a stepping stone
Correct.
into the syndication model, which I'd like to talk a little bit about, that.
Sure.
Because obviously we just, went over general form, joint venture partnership. You bring in an investor, they help fund the down payment, and you use hard money to get the rest. That's very logical for people.
Totally.
Syndication is pretty much the same thing, but at a different scale.
Correct.
So what made you decide that syndication was the model when you were looking at that 69-unit portfolio, and how did you navigate getting that set up?
So the syndication model strictly made sense due to the size of the deal, right? Because it was so large that we couldn't bring one or two investors. We had to bring a plethora of investors. And when you have to bring that many investors, do you think all of them are going to have an active role? Absolutely not. So the syndication model made sense for this particular opportunity. I mean, trust me, I would love to take down a $6 million asset with one investor and us just JV it, right? That makes sense all day because I don't have to cut up the returns and give it to my limited partners in a syndication. But a lot of times you don't have the ability to do that for the larger deals.
Right. Is there a number that you use as a golden rule? What's the golden rule for syndication versus joint venture? Is it strictly participation, or is it number of people that starts to?
Yeah, it would definitely be the number of people, right? Because you could only provide so many roles, active roles to people. It would be the actual sunk costs associated with legal fees, because at the end of the day, that's not increasing your value of the property. That's just straight sunk cost, right? So you're probably looking at between $2.5, $3 million purchase price for having a 20, 50K sunk cost makes sense in a property, right? So there's many different aspects on how a syndication would make sense. But at the end of the day, what I would say is for most newer investors, if you run across a larger deal, syndications do make sense because you have the ability to raise money from friends and family in a compliant way, right? A 5 or 6B. And most people start out with 5 or 6Bs before they go to a 5 or 6C. We can openly market it to the public because you don't really have that credentials, that credibility to do that.
And at that point, where do you learn more about it? Who's the first person you should call if you're I want to start a syndication? Do you call a corporate attorney, or do you talk to other investors who have done it? How do you go about learning more about the real nuances of establishing something like that?
Yeah, I mean, you could obviously read books, listen to podcasts. I mean, there's plenty of syndication podcasts out there. I'm really like The Hands-Off Investor by Brian Burke. That's a really solid book. The Multifamily Millionaire Volume 2. That goes a little more deeper into syndication models as well, right? So those are some resources I would recommend for syndication models. But at the end of the day, you're going to learn the best if you get a mentor, right? A local mentor. And that's what I did. I found a local mentor who owned 500 plus units, was doing these syndications on a daily basis, right? And I found a way to provide them value, and they took me under their wing, right? So that's what I would advise your audience to do, is find somebody in your market doing what you want to do at a larger scale. Could be flips, could be syndications, could be straight joint ventures, right? Find a way to provide them value and learn from them as much as you can. And sooner or later, if you just watch what they do on a daily basis and you copy and paste that, over a course of 2, 3, 4 years, you're going to be in a similar situation as they are.
That's super great advice. And I think real estate at the core is a relationship game.
Yep.
But especially with the mentor piece, that's the gasoline on the fire.
Totally.
Because it's a replicatable model in a lot of senses, where I think real estate has that component to it where, to me, and I think a lot of people, it's very logical in a lot of senses. I buy a building that isn't that nice. I put money into it. I make it worth more. I increase the rents. It's worth more to investors.
Yeah.
I can sell it, or I can keep it and take money. So
Correct.
It makes sense.
And there's not a lot of variables either.
Right. For the most part, until you get to more complex situations.
The larger stuff is very similar to the smaller stuff. There's really not that many variables. I think those variables come into play when people are really trying to sell bad deals.
Right.
Look at this ARR. Look at this average return over 20 years. If it doesn't make sense in the back of a napkin, it's not going to make sense in your fancy smancy Excel model,
Or if it does, the Excel model might just be giving you the numbers you want to see.
Exactly.
And I think that's true within the same asset class, multifamily. And what made you decide that multifamily was the asset class for the syndication model and for you versus the multitude of other different real estate classes?
So I primarily chose multifamily due to my time constraints, right? I was working a W-2 at that point. And I was simultaneously working a W-2 while being an investor-focused agent and building this real estate empire, right? So what made sense to me was long-term rentals that don't require a lot of time, right? When it comes to real estate asset classes, different asset classes provide higher returns, but require more time. Short-term rentals, better returns, more time. Medium-term rentals, better returns, more time. Flipping, that's a job, right? Better returns, more time. Multifamily made sense to me because I didn't have a lot of time and I wanted to build a portfolio in real estate. And, how did I decide to syndicate multifamily? I'm more or less like, I don't suffer from shiny object syndrome. Like, I pick one thing and I get really, really, really good at it. And that's exactly what I did. I put over 10,000 hours into learning multifamily. And now that I put the knowledge in, I'm trying to leverage it as much as possible.
That point I feel is so often missed by people, of finding your niche and just getting really good at one thing before you start to do others. And then once you get the systems down, then you can expand like you're actively doing now by doing more flips, doing different types of projects, because you have the systems in place that you can now translate into other types of deals.
Yeah, and I mean, my real niche of being the Worcester multifamily guy has really exacerbated my ability to scale. Like, people know me in this market. People bring me deals. I host the largest real estate meetup in Worcester. When people think of Worcester, people think of multifamily, they think of me, right? So when some of these larger deals come across people's desks, and I already own 100 plus units in that market, who do you think they bring it to, right? So having a niche and going all into that niche is incredibly important. And when it comes to a niche, you want to go a mile deep and inch wide, right? So that might be multifamily in one specific market. That might be flipping in one specific market. But the broader you get, the harder it is to laser focus and the harder it is to become an expert on one specific asset class and market.
And how do you, for someone listening, how do you make that distinction? Or what advice do you have for someone trying to make that choice of like, what do I want to do? Because I think real estate especially, there's so many shiny objects, and everyone is able to glamorize some piece of it. Flipping, you have HGTV shows, and you have being an agent, on Selling Sunset, and you have the large multifamily, developments you see on Instagram and Facebook, and it all looks great, but they're also different. So like, what would you say to someone who's like, I want to get into real estate, but I don't know which way to go?
I would first start with analyzing your strengths, right? Maybe take a personality test, maybe talk to some of your family on what they think your strengths are, right? And align that with the asset class, right? And simultaneously see where you're not strong and possibly contemplate partners that make up your weaknesses, and where they're strong, you're weak, and where you're weak, they're strong. And when you find that partner combined with your strengths, your ability to scale is exponential. So that would definitely be my advice for somebody. Additionally, when it comes to real estate investing or investing in general, there's a million ways to become a millionaire. You truly just have to choose a strategy, go all in, commit, and keep your head down for years. And when you pick your head up, you're going to have quite the portfolio to brag about. So that'd be my advice to people trying to get started in real estate.
That's find your niche, stick with it, and don't stop until you've put in a lot of time, because once you commit to it, you will see success in the long run. But I feel like a big question people have on that, and I'm sure you hear all the time, like, can't find any deals. Like nothing pencils out. But I feel like it's a lot of the time, one, they don't know exactly what they're looking for.
Correct.
So they're looking for the right deal in the wrong market.
Totally.
And they don't know how to see potential. So for someone who's in that boat of like, I have capital, I want to buy a deal, but I can't find one, what advice would you have for someone who doesn't maybe know how to underwrite, defining their buy box?
Totally.
How do you get focused on that?
You have to find somebody who knows how to see value where value's unseen. And a quick example of this would be, my partner Zach and I, we recently got a 5-unit under contract in Worcester, right? A 5-unit in Worcester for $730,000 in fantastic condition, right?
It's a good deal. 3
families in Worcester sell for $650,000, $700,000 now. Even some are like $750,000, right? This is a 5-unit, all 4-bed units and 2 commercial. Pro forma market rents on this building is $10,000. If anybody knows real estate, knows the 1% rule, it's far above the 1% rule. This thing's on a cash flow all day. How did I find this deal? It was on the MLS for 100 days. It was mismarketed as a commercial property, even though 3 of the units are residential. Nobody saw the thing, right? We saw it right in the MLS. It was listed for $750,000. We got under contract for $730,000. Made sense all day, but that opportunity was out there for everybody to see. Nobody saw the value besides us, right? So, if you can't identify value, find an investor-focused agent. Find somebody who can see the value and or become part of a community, a network that can teach you how to find value, right? Quick tip, easy way to find value is a mismatch between bedroom count and square footage. That's an easy tip. Say, for example, you run across a 3-unit property, 4,000 square feet, but each unit's 2 beds. 1,300 square feet for a 2-bed, that makes absolutely no sense. Most likely you'll be able to create 1 or 2 bedrooms in that 2-bed unit, creating a 3 or 4 bed unit. And now you actually have the 3 or 4 bed units on that 3-family, and you're paying 2-bed prices, right? So that's a quick example of how to find value, but there's many ways to find value, and you got to find the right team member to help you along that process.
That's finding that agent is really important.
Yep.
Because I think it's funny, a lot of times, like agents will say they can help, and I love agents. My business is built on agents. So if you're listening to this, don't take offense, but it's agents try to sell houses and they never own a house. So they try to sell an investment property, they don't own their own house.
Oh.
So it's really difficult to have that experience of guidance. And I would imagine, I know you're an investor-focused agent and your team, behind you is investor-focused agents. Like you help your clients underwrite deals.
Yep.
You help them identify markets, opportunities. And that piece I feel like is super important where you don't have that real world experience to draw from, but it almost gives you like a built-in advisor, because that's really your role is as an advisor. And in that process, how do you approach that, underwriting time where someone comes to you and says, Andrew, look, I want to buy a 3-family. I want to buy a 4-unit, but I don't know what makes a good deal.
Totally.
And I want to learn. So how would you advise someone to look at a quick deal analysis to be able to quickly tell whether or not a deal is worth your time?
So it all comes down to the market rent versus the all-in cost, right? So say, for example, you buy a 3-family for $500,000, right? All 3 beds, you have the ability to make them 4-bed units, right? So 4-bed units in Worcester rent for $2,500. So once you turn them to 4-bed units, that building can produce $7,500 in revenue. Say, for example, it takes you $50,000 to do that. So you're all in $550,000. And the property at its best state produces $7,500 in monthly revenue. That's far above what we refer to as the 1% rule. The 1% rule is 1% of the purchase price equals the monthly rent. So if your market rents 1.1, 1.2, 1.3 above the 1% rule, there's a good chance that thing's going to cash flow well, right? So I use that very quickly just to analyze deals to see if it even makes sense before I actually pull on my calculator and start putting it through my model. And
so 1%, you're saying obviously $500,000 purchase price.
Yep.
Rents would have to be $5,000 a month.
For the 1% rule. And that's assuming you put no money into the property.
Right. And then if that checks, then you can start to look at other value add opportunities.
Correct.
Can you add that extra bedroom? Can you finish an attic space? Those types of nuances.
Yes, and I'm looking at that day one. My pro forma, my market rents is take into account the value that I can create and how much money it will take to create that value. Like in that example, I explained I'm going to turn them into 4 beds, right? That might take $5,000 or $10,000 of carpentry work, adding a door, adding a partition, adding a closet to make them 4-bed units. So I take that into account in the purchase price to determine whether that makes sense or not from that 1% perspective.
And what are some of the most common value add opportunities you see on like the smaller scale multifamily? Like if I'm buying a 3-family for myself or I'm buying a 4-unit, adding a bedroom, what are the types of things would you tell people to look for in a property to find that extra value? Adding bedrooms is in the easiest way and the cheapest way to find more value, right? Another way is potentially attic space, right? If you have a really big attic, you have the ability to maybe create a couple more bedrooms there, and maybe connect it to the unit below and create stairs and add bedrooms that way, right? These are really cheap and easy ways to create that value, and then there are other ways to create value. Like, for example, I told you about that Boston condo project that I'm doing. With that particular deal, it makes okay sense as long-term rentals, but when you condonize each unit, it exponentially increases the value of the property by 30 to 40%, right? So that's another example of because we're reorganizing the property and we're setting it up in a different fashion, now it's actually worth 60 to 70% more, right? So those are some quick examples of how you can create value. And, always keep in the back of your mind, the ability to condo down the road. Because sometimes you run across these multis that are side by side, right? Those are super easy to condonize. And a lot of times, especially in these growing cities, when you condonize a property, each individual condo will sell more than the sum as a whole, right? Right. It's worth more to the average person as an individual unit that you own. Yeah. And when you say condoize, obviously you're talking about taking a multifamily in which one person owns the entire building,
Correct.
all 3 floors, and usually rents them out,
Yep.
and creating individual ownership in the form of condos for each of those units. That's selling those out to regular people.
That's exactly correct. And a lot of times, depending on the town, but it could be as simple as just filing some paperwork, right? A lot of times colonizing in these cities are not very challenging because, at least where we are at, there's a housing shortage, right? So cities actually want more housing. So a lot of times they'll help facilitate that by, pushing through condos pretty easily.
Now, to keep going on this rabbit hole, because I love this approach, how do you deal with tenants being in place at the time you want to convert? Because typically my understanding is you have to offer first right of refusal to those tenants saying, hey, I'm going to convert it to condos. You have X amount of days to tell me if you want to purchase it. Do you run into that at all? Or how do you typically navigate tenants being in the building at the time you want to convert?
We typically have to get them to leave, right? So we give them a notice, if they're unwilling to leave, we'll offer them cash for keys. We'll make some sort of situation for them to want to leave, right? Potentially we'll have to go through the eviction process, which might take 4 to 6 months, right? But at the end of the day, we have to get them out because to condoize a property, a lot of times you have to have better finishes than a rental, right? Condo grade finishes are a level up from rental finishes. So to truly get those condo prices, you really have to cosmetically upgrade it to have islands in the kitchen, nice granite shower, make it look really nice. And that's going to really demand those condo prices.
That's a super important distinction. I've heard some horror stories of people going after a condo project, but realizing the building wasn't really meant to be condos. It doesn't have the layout or maybe the structure or the type of finishes like you're saying. And they go through the whole process and realize the end product wasn't what someone looks for in a condo.
Yeah.
So super important.
I mean, when it comes to real estate, you really got to understand your end buyer. And condo buyers are very much like first-time home buyers. They want something beautiful, cosmetic that makes them feel wonderful when they walk into it, right? Us investors have a completely different outlook, right? If
dollar signs.
Yeah. If we walk into a property and we see problems, we're like you said, we see dollar signs, right? So we have different things we look for when it comes to deals. So you really got to understand your clientele and the end buyer when doing business decisions. Otherwise, you might, your exit strategy might not pan out the way you think it's going to pan out.
Yeah, that's really important. And condo, I feel like when you start to see condo, repurposing of multifamily into condos, it's almost like the sign of a really developed market. Do you feel like Worcester is going to experience the condo play more often because of just how much the market's appreciated, the demand? Mm-hmm. Do you feel like that's a market that would see, some condo redevelopment, or is it really more into those bigger cities like Boston and Providence that you'll see that?
I definitely foresee a future in Worcester where condos are a norm in these 3 families. But what I will say is, as of now, on a per unit price per condo versus an actual price for a 3 family is really not much difference in my humble opinion. But I definitely think that's gearing up down the road for sure. I mean, Worcester is one of the fastest growing cities in New England. At a certain point, I think the city's going to want to push for as much, owner occupied housing as possible. So I can definitely foresee that being in the future. But at the end of the day, there is a lot of just development happening in Worcester in general. I mean, if you know Worcester at all, and Lake Ave, it's touching Shrewsbury, and Shrewsbury is a very high-end town. On that entire block, on that entire road, there's so many new developments happening that it's crazy. So
you feel like that's where you have that price disparity of, well, I could pay $250 for maybe a condo in a 3 family, or $300 in one of these beautiful new buildings.
Yeah, or I could pay $250 for a condo in this 3 family, or I could pay $750 for the actual 3 family.
Right.
There's really not that much profit to be made by separating into each individual condos. I'd rather just sell my 3 family off and not go through the trouble.
Right, not go through the process.
Exactly.
Sure. So with the condo play, I think that's something we'll have to watch in the Worcester market, and maybe over the next couple of years,
Mm-hmm.
We'll see that happen. And if it does, I'm sure you'll jump on it. So
totally,
we'll just follow you online and see that play out. But as we near the end of the episode, I did want to get into some really detailed examples of a deal, because a lot of people wonder, how do you make money? How do investors make money?
Totally.
How does it all work? So we obviously talked a lot about hard money.
Mm-hmm.
And I think it'd be really helpful to walk through a live example of a deal you just did and show the breakdown of how the deal worked on your end.
Totally.
And how the deal worked from the investor side of things who gave you the capital.
Great. So this one deal comes to mind when we actually closed on it on Friday. So we found this 3-family in Webster, Massachusetts, which is pretty close to Worcester. And for this 3-family, wholesaler brought it to us for $300,000, right? It had 2 gutted units and the first unit was rented. Needed probably about $120,000 worth of work. And we anticipated the end value, the ARV after repair value, was around $550,000. So we went to a hard money lender that offered it 90% of the purchase price, 100% of the construction. So we essentially only had to bring 10% of the purchase price and a couple points. A point is 1% of the purchase price, right? So we went to an investor. We had to bring approximately $70,000 with the 10% down plus operating funds. So we went to an investor and we said, hey, for you letting us borrow the $70,000, we'll give you a $35,000 profit. Really good deal, right?
So from that point, you needed a $300,000 price. You need 10% down, so $30,000, and then you build in funds from your investor so that you don't have to bring any capital to the deal, and you bring that extra funds beyond 30 to cover your operating account. Just in case any reserves come up.
So, the thing about hard money is they're going to give you the renovation money, but you have to front the money and get reimbursed, right? So that delta above the 10% down was in our operating account, so we could do the work and reimburse ourselves as it went, right? So for that particular property, we put about $120,000 into it. We redid all the electrical, we redid the plumbing, we installed 2 heating units, and we cosmetically upgraded 2 units, and the 3rd unit was in fantastic shape. So we put about $120,000 into it. So we're all in, $420 plus holding costs or whatever, right? We ended up getting it under contract and selling that property for $585,000, right? So after everything was said and done, we made about $100,000. We gave our investor their $35,000 profit plus the $70,000 they originally gave, and we split the difference among the partners who actually operated the deal.
And so you guys had made $70,000 off that?
Yeah, approximately $60,000, $70,000. Yes, that's exactly correct. So that's a quick example of how we created money out of thin air by knowing how to identify opportunity, how to borrow money, how to bring investors, how to successfully project management a flip to fruition, and how to sell it at a higher price than our ARV demanded.
But to your point earlier, your value was found the deal, you're going to operate it, you're going to execute, and this investor was just bringing their money.
They were simply bringing the money, and this was our first flip, so we did give the investor extremely healthy return. But yeah, that's more or less kind of how we do these sort of in and out sort of deals, yes.
And you structured it under an LLC, or was there a formal agreement?
We structured it under an LLC, and the investor had, a claim to the property if for some reason we didn't fulfill our promise.
That's good to know. I feel like a lot of people, for some reason, get caught up in that point. Like, how do I formalize it? I know I have a property, I want to buy it, but I don't have money.
Yep.
How am I going to convince another person to give me their money? Which, of course, is the track record and experience, but they get stuck at I don't know what to do.
It's also the deal. A 3-family in Webster for $300,000, you don't need to know real estate to know that's a screaming hot deal when 3 families in Webster sell for $500,000 to $600,000, right? So, when it comes to raising capital, it all comes down to finding amazing deals, right? I recently closed on a 39-unit syndication in Worcester, Massachusetts, right? We got each unit for $125 a door. If anybody knows Worcester, they know units in Worcester sell between, $175 to $250 a door, right? So literally us just signing the papers created millions of dollars in equity. So finding the deal makes it extremely easy to raise for these opportunities. Because at the end of the day, if you don't fulfill your promise, if you don't follow through in the deal, they'll just sell it and collect the difference, collect their money back because there's so much built-in equity in the opportunity.
That's a really good point. The deal speaks for itself.
Correct.
And your track record backs it, which is important.
Yes. Starts with a good deal, then the track record. But definitely the operator is extremely important, but it all stems from a solid deal for sure.
I think you were actually the one who told me this years ago when I first met you at a meetup. And it stuck with me. You always said, you find the deal, you'll always find the money. You'll always find the money. The money's not the problem, but have a good deal and people will invest.
Totally. Totally.
It's something I still think about. I joke with my, girlfriend when I find a property online and maybe it's $1 million, $2 million, over what I probably would be comfortable taking down. Or she would be taking down rather. And I always say, well, find the money.
Well, I think you're missing one key ingredient there, getting control of the deal. Because you can find a deal, but if you don't have control of the deal, somebody could snatch it from underneath you.
Getting under contract.
So getting it under contract and having a contractual obligation to a deal is incredibly important for getting the money, right? Because I've been in that situation where I didn't have a deal under contract. I tried to raise money for it, and somebody essentially tried to steal it from me. I had to pay more for that deal to close in the deal. So you got to be careful with doing that if you do not have control of the deal.
That's really important. Yeah. That's especially off market because you never know. They could be talking to 10 people and you just have a one-line communication.
Correct.
Yeah, that's super important. I just wanted, as we near the end here, I wanted to wrap things up with one question that I know you have put a lot of thought into over the course of your career, and that is your top 3 recommendations for either books, resources, or communities where you can learn more about real estate investing and become a better investor.
Totally. So definitely get yourself in a community of other real estate investors, right? And that's how I really scaled. Was I found a community that I could dive into that had my mentor that allowed me the knowledge and the resources to scale. So I'm part of Candor Realty. We're an investor-focused brokerage, and we have meetups all over Massachusetts, right? So that's a fantastic way to start building a network and start building a team to buy real estate. An effective book for me in helping scale my business has been 7 Habits of Highly Effective People by Stephen Covey. That's essentially, time management and how to reverse engineer the reality you want to live in. So it's incredibly, that was incredibly powerful with scaling my real estate portfolio. And I would definitely say anything from Brandon Turner. The book on managing rental properties, fantastic book, right? The Multifamily Millionaire, Volume 1, which is great for a house hacker or somebody really just looking to get started in real estate. Low and no money down, like that teaches you how to utilize 401ks, how to utilize HELOCs, right? How to utilize refinances, 1031s, how to leverage equity in other properties or other asset classes to buy more real estate. So those are some resources that really help me scale quickly in real estate.
Thank you for sharing, Andrew. It's been a pleasure having you on, and I'd love to, in the future, hopefully have you back and talk more about some more deals, and I'm sure you'll have more to share with us. But for those listening, they want to learn more about you.
Yep.
Where can they find you online?
They can definitely find me on Instagram, Investor Freed, and Facebook and LinkedIn at Andrew Freed. You could also find me on a plethora of podcasts, including Bigger Pockets. And yeah, if you're interested in learning more, looking for investment property, interested in opportunities that we have available, definitely feel free to reach out. I'm happy to have a chat.
Awesome. Thanks, Andrew.
Thank you.